Hi friends, today in this video we are going to discuss in simple terms about rising interest rates and fear of recession. So what is this interest rate and recession? So this is particularly about US market, United States of America, and they call it as Federal Reserve. So the Federal Reserve, so like in India we have RBI, Reserve Bank of India. Likewise, there is Federal Reserve in USA. Okay. So the Federal Reserve have already started to raise the interest rate in the last March meeting. So what if the rates are going to go up? The Federal Reserve has started to increase the rates. Okay. Now what is the impact? It increases the borrowing cost for banks and everybody else, because the banks borrow money from Federal Reserve and we borrow money from bank. So the interest rate goes up and everybody's borrowing cost is going to go up. Okay. So the next we see the mortgage loans, credit card rates, everything going up. So the major impact of this will be the consumer. The consumer will start to spend less money. As the interest rates are going up, I have to pay higher rate to the bank and I am going to pay higher rate for my credit card bill, everything. So what will I do? I will be starting to reduce my expenditure. Okay. So what will happen? Say for example, I go for a market, I go out to the market and buy something weekend, I go and spend like $100. Now I'm going to spend $60 to $75 alone this day. What will happen? So the company's sales goes down because I am cutting cost now, I am cutting my expenditure. So what will happen? The sales of the companies will be going down. The next, this affects the entire earnings of the corporate. So the stock market is trading on the basis of the corporate earnings. So if the sales of the companies are going down, this will affect the entire stock prices to go down because their earnings are going to go down. So the valuation also starts to go down. Okay. Now the main important sector, tech stock. So tech stocks are particularly very sensitive because they have the cash flow. So what is the cash flow? The available cash in the corporate hands and the people, common man hands. So now it is going to be affected. I'm not going to have an abundant cash supply in my business. So particularly we are living in a tech world. So countries like US, China or even India, the biggest contributor for the economy is tech companies only. So when the tech stocks are so much sensitive and they are affected by discounted cash flow, their cash flow is reducing. So what will happen? Though the larger the expected growth of future earnings, because we have like a forecasted earnings for every company. Say if a company is growing like 1000 crore now, a company is having a profit of 1000 crore this year, they will be giving a projection for 1200, that is 20 to 25% each and every year growth. So next year they will be growing at 1200, 300 profit. Then the next year 1500. So likewise it will be going up. So the stock market price of the stock also will be going up according to high valuations on high future expected earnings. Now the interest rate goes up, but the present value of the future earning goes down because next time the company may not deliver the same expected earnings. This year I got 1000 crore profit. The next year I expected 1200, but now I'm having 1100 only. So 10% earnings is affected due to the higher interest rate. So what will happen? The valuations will be affected. There will be an immediate correction in the stock market point of view. So stock market are always trading at forward looking. So that is the important key. Markets are always forward looking. So market will not wait for 1 year. If you are reducing your projected earnings for this year, stock market will, the very next day itself, the price of the stock will be reduced because it is forward looking. You are not going to deliver the expected earnings next year. So why should I invest and wait for next year, 1 year? I'll be definitely taking my fund out of your company. I will not invest much in a company which is going to have a lesser growth. So that is how the market works, right? Now we go for a chart. This makes the investors worry about recession. So we'll come back to recession in the coming charts. Now, where is the money going? Okay, I'm going to take the money out of my stock market. Okay, now where will I put? So that is the key. This chart below you are seeing is the US government 10-year-old treasury bond. This is bond. So it's a safer income. So bonds are always the safest income as per the government point of view. So now I have put my money into stock market. If it is as long as it is giving a good returns to me, I will be remaining invested in stock market, and even I will be investing more in stock market. Okay, now my business is giving more income than any other things, then I will be remaining invested and I will be expanding my business. Okay, now both is not happening. The business earnings are going down, stock prices are going down, so stock market also not giving me returns. Now where will I put my money? I have to put money in the bond because it is a protected earnings. So see, like in US in 1980s, the interest rate was around 15 or 16%. It was like the highest ever. And after that, when due to the industrial growth of globally, every country has started to grow, and US also was keeping on growing. From there, they lowered their interest rate gradually years from 16. It nearly at COVID time, 2020, March 2020 COVID time, the US went into flat interest rate, that is 0 to 0.25, the lowest ever in their history. So this is how it works. Now see, after 2020, when the businesses start to recover slowly, but the fear of recession, people are got into fear that there is no growth as expected as the business is growing, but interest rate has started to go up due to inflation. Every prices of the product is going up, I am not able to spend, so I am getting a fear. So that fear, the money is being dumped into US bond from 0.25, it is now trading at 2.9. So what if this interest rate is going to go up 4, 5, 6, 7 like kind of a scenario? In India, we are sitting currently at I think 7.6 kind of 10-year-old bond. US 2.9. So this is a very, very, very bigger problem on the longer run. So money is being chased into bond, safer investment, like how we treat as fixed deposit as a safer investment. We don't want to put in money in business. We don't want to put money in other kind of venture. So we are not we are not certain about our earnings or profit. So business is not going good. My earnings is not going up. My income is not going up. But my expenditure is always going up. So I have to put money, my safer investment and my savings into a safer hand, which gives at least assured returns. So people go for fixed deposits or bonds. Okay, now this is the US Dow Jones index. Now you can compare these both chart. In 1980, US Dow Jones index was around 1000. Now currently it went up to 36,000, and even in the last couple of weeks it has corrected 3,000 point nearly. So we are trading at 33,000 something. From 36,000 it has come down 10%. Now if you compare these both chart, interest rate at 1980, US Dow Jones at 1980. Interest rate now at 2022 started to rise, and US Dow Jones index at 2022 started to fall. Yes, in between we had a lot of corrections, but those were except 2008 correction, nothing was a bigger meltdown. In 2008 alone, index fall like 60 to 65% correction we had. And in 2020 we had a corona crash, but it was very, very short lived. Within months it just took off and gave a splendid rally. So this happened in all the global markets. Yes, now this is the fear. The US experts, the economists, financial experts, everybody is fearing that this inversion in the yield curve is going to trigger a massive sell-off in the US stock markets. So what happens next? So this is a business cycle, like a common easy concept of what is the business cycle. Each and every business cycle has an expansion, then a peak. So now, as per the experts, they are saying this is the peak. So you can see this is the peak. So stock market point is actually a replica of how the business of the entire country is doing. So they feel that no, yes, we are at the peak. So they are thinking of a recession, and it will lead to depression. So example of depression is this area, this zone. We had a recession, then a deep depression. From there, so recover from a depression, it took almost from 2009 to 2014, 5 years. The entire global market took 5 years to recover from the depression and again expansion. So they are feeling like we are in the phase of a start of a recession, then depression. After a trough, we will see a recovery kind of a phase. So this is not going to happen in a 1 year, 2 year. This entire business cycle will be expanding a minimum of 8, 12 and sometimes even 20 years of a time horizon. So it will take nearly 4 to 5 years from recession and depression and start a recovery kind of a scenario. So now, what is this characteristics of a recession? Okay, so simple, like businesses cut back their production. Okay, now my business is not going down, doing good, so I will be reducing my production because I am not able to sell it. So it will be leading to more loss. So I will be cutting my production. Some business, small business which are not able to repay their loans may even go bankrupt. And consumers, so this should have been actually the first point. Consumers spend less money. So this will be leading to production cut and bankruptcy. And main important point, individuals may lose their job. So as we have discussed, IT is the first sector which is going to be affected by higher interest rate. So there will be more layoffs and people losing job in their IT. So individuals may lose their jobs. That will lead to government has to spend more on unemployment benefits. So because people are losing job, so the government is under a bigger pressure. The government treasury will also start to lose their money. So this is going to be much a bigger problem in the longer run. And less money in people in the hands of people, company, everything will lead to less money collected by the government. Now where is the government going to collect their tax from? My business is going down, my salary is going down, so the tax collected by the government also will be going down. So ultimately, what is the impact is the prices. Every price will fall. So stock market will be collapsing first, and after that later the prices of the product also as ultimately go down, and after that only we will see the inflation going down. When the prices starts to fall, so that will be the point where we may go to a recovery. So the prices has to fall down first. Then if the inflation is coming down, again the government may think of reducing the interest rate. And then slowly we can see the recovery. So the conclusion, so far I have been talking about the US markets and US treasury yield only. Why? I'm not talking about our particular India here, because we have no other way. Because US is the mother of all markets. It will be impacting all the other markets, and India particularly, as we are the emerging market, we are completely dependent on the global superpowers. So anything which is affecting India, US, will be affecting all the emerging and other global market also. So globally everybody is positioned in that manner only, at least in financially. I'm talking about the financial markets alone. Yes. So what may happen in the coming months and years? So expect a sectoral rotation. The sectoral rotation during corrections, well, the money will be moving out from tech particularly to energy and industrials and even banks. So banks will be starting to do well because they are going to have a higher interest rate. So that will lead to more increase in earnings for them. But they have another problem of NPAs. So if the banks are going to suffer by more NPA, even bank may go into bankruptcy. So that is what happened in 2008, Lehman Brothers collapse. So that was a problem. In depression time, even banks were not stable. So we have that problem also. But if the banks are able to keep their NPAs well lower, then I think it will be banks can be a good performer in the coming years. And as I told earlier, this is a longer process. It will take years to come out of recession and lead to recovery and further expansion. So these are all financial concepts. So like a simple advice in the stock market point of view is keep your money and investments safer. So please subscribe and share my YouTube channel. In description there is a link to my Telegram channel downside, so you can follow me, my group, for regular market updates. So thank you all.